AI earnings prediction models. How AI forecasts company profits. Artificial intelligence is revolutionizing the way investors forecast company earnings and make informed investment decisions. Traditionally, predicting a company's profits required analysts to manually study financial statements, track market trends, and rely on experience and intuition. While this approach has value, it can be slow, subjective, and prone to error. Today, AI earnings prediction models are transforming this process by using vast amounts of data, sophisticated algorithms, and machine learning techniques to provide more accurate, timely, and actionable profit forecasts. In this video, we'll explore how AI forecasts company profits, the advantages of using AI-driven earnings prediction models, the common pitfalls investors should avoid, and how you can leverage these tools to improve your investment decisions. At the core of AI earnings prediction models is machine learning. These models are trained on historical financial data, including revenue, expenses, profit margins, cash flow, and balance sheets, combined with external factors, such as industry trends, economic indicators, and even alternative data like social media sentiment, news, coverage, and web traffic. By analyzing patterns across this vast dataset, AI models learn to identify the key variables that impact a company's profitability. Over time, the models improve their predictions, becoming more accurate as they process more data and incorporate new trends. One of the main advantages of AI earnings prediction is speed. A human analyst can spend days reviewing reports, earnings calls, and news articles to forecast profits for a single company. AI models, on the other hand, can process millions of data points in seconds, providing near real-time earnings predictions. This speed allows investors to act on insights faster than the broader market, which can create opportunities for strategic trading or portfolio adjustments. For U.S. investors, this means being able to respond quickly to earnings surprises or market-moving announcements. Another significant benefit is objectivity. Human analysts are influenced by biases, emotions, and subjective interpretations. AI models rely purely on data-driven patterns, minimizing the risk of emotional This objectivity helps investors avoid overreacting to hype, rumors, or short-term market volatility, allowing them to focus on long-term profitability trends. However, it is important to remember that AI predictions are only as good as the data they retrained on. Garbage in, garbage out still applies, so ensuring high-quality, reliable data is critical. AI earnings prediction models can also incorporate alternative data sources that traditional analysis often ignores. For example, web traffic data can indicate consumer interest in a company's products. Satellite imagery can track retail, foot traffic, or manufacturing activity, and social media sentiment can reflect public perception of a brand. By integrating these unconventional data points, AI models gain a more comprehensive view of a company's performance and potential profitability. This holistic approach allows investors to detect emerging trends and market shifts that might not be apparent through conventional financial reports alone. Natural language processing, or NLP, is another crucial component of AI earnings prediction. NLP algorithms analyze earnings, call transcripts, SEC filings, press releases, and financial news to extract key information and detect subtle patterns in language. For instance, cautious or hedging statements in an earnings call might signal potential risks, while confident language could indicate growth potential. By quantifying these textual signals, AI models can refine their earnings predictions and provide investors with more nuanced insights than numbers alone would suggest. While AI earnings prediction models offer remarkable advantages, it's essential for investors to understand their limitations. One common mistake is over-reliance on the model without human oversight. AI can provide predictions, but it cannot account for sudden geopolitical events, natural disasters, regulatory changes, or unexpected company-specific developments. Investors must combine AI insights with traditional research, market analysis, and risk management strategies to make well-informed decisions. Treating AI predictions as guarantees can lead to overconfidence and significant losses. Another challenge is model overfit. Some AI models are trained too specifically on historical data, performing well on past events but failing to generalize to future scenarios. For example, a model trained on past tech company earnings may struggle to predict profits for a new biotech startup. To avoid these, investors and data scientists continually retrain models with fresh data, test across different industries, and adjust parameters to improve generalization. Continuous monitoring and validation are essential to maintain accuracy and reliability. AI earnings prediction is also transforming how institutional investors, such as hedge funds and asset managers, approach investment decisions. Large funds often use AI to model multiple scenarios simultaneously, simulate potential outcomes, and forecast earnings across hundreds of companies. This level of analysis allows them to allocate capital more effectively, manage risk, and identify opportunities before retail investors can react. For individual investors, using AI-powered platforms or subscription-based tools can provide access to similar insights on a smaller scale, leveling the playing field in the competitive U.S. stock market. Timing is another critical factor. AI models can not only forecast earnings but also anticipate when surprises are likely to occur. Earnings surprises when actual profits differ significantly from analyst expectations lead to rapid stock price movements. By analyzing patterns from historical surprises, market sentiment, and external data, AI can help investors identify companies with a higher probability of exceeding or missing earnings forecasts. This predictive power allows for more strategic entry and exit points in trading or long-term investing strategies. Investors should also consider the importance of scenario analysis. AI models can generate multiple potential outcomes based on different assumptions, such as changes in consumer behavior, macroeconomic conditions, or industry trends. This enables investors to assess risks and rewards under different scenarios, improving decision-making and portfolio management. The combination of predictive analytics, alternative data, and scenario modeling gives AI earnings prediction models a unique edge in modern investing. To summarize, AI earnings prediction models provide investors with a faster, more data-driven, and comprehensive way to forecast company profits. By combining historical financial data, alternative data sources, natural language processing, and machine learning, these models help investors anticipate market trends, detect earnings surprises, and make more informed investment decisions. While they are powerful tools, they should always be used alongside human judgment, risk management, and traditional research methods to achieve the best results. If you found this video valuable, make sure to subscribe to our channel for more insights on AI in finance, personal finance strategies, investing tools, and market analysis. Like this video to help others discover the power of AI in investing. Leave a comment, sharing your thoughts or questions about AI earnings prediction models. And share this video with friends or family members interested in smarter data-driven investing. By understanding and leveraging AI for earnings prediction, you can make more informed investment decisions. Stay ahead of market trends and optimize your portfolio for success in today's competitive stock market.